For decades, Al Cleinman has been a student of the business of optometry. As a consultant, he's been instrumental in the development of some of North America's most successful optometry practices. Each week, he addresses timely topics to help optometrists build and improve. And now, here's Al with his insights on the business of eye care.
This week, a short lesson on cash flow. Harold Ganin, the great CEO of the conglomerate ITT Corporation, once said, "The only unforgivable sin in business is to run out of cash." Truer words were never said. But with the past decade's ready access to credit at low rates, I have a fear that many are experiencing a cash flow squeeze, the result of two forces at work. "Al, I'm very profitable, but I don't ever have any cash," is a comment that I hear more often than I'd like. It's surprising how many professionals fail to understand the difference between cash flow and profit. It's entirely possible to have large profits but no cash, as it is to have cash but register a loss. This is simply because items like principal payments on debt do not show up on your profit and loss statement. They're not an expense, but a balance sheet item. Let's suppose that you bought a practice in 2018 and borrowed $250,000 to do the deal. You took out a 15-year loan at 4.5% interest. Your payment in your first year is about $23,000, of which about $11,000 was deductible interest. However, the $11,750 you paid out in principal isn't recorded on your P&L. Those funds are a reduction in cash and your liabilities. Such outflows are a balance sheet item. Thus, to have positive cash flow, you must first have profit more than the principal payments on debt and other similar items. Now let's roll that clock forward to today. You're 5 years into the loan, which had a 5-year repricing as part of its terms. The loan that started out at 4.5% is now 7.5%. That loan was costing you $23,000, but now costs $28,000, of which a bigger percentage is principal. Principal payments increase as your loan amortizes, so each year of the loan you need to make more money to have the cash necessary to fund the principal payment. Many of you took out large loans in the past 5 years when credit was readily available at historically low rates. Unfortunately, many of those loans had variable interest rates and are now repricing upward substantially. And this cash squeeze is being exacerbated by large jumps in inflation. Indeed, between 2018 and 2022, cumulative inflation has reduced the purchasing power of your dollar by 18%. In other words, the dollar you had in 2018 is now worth only 82 cents. My point, if you're not managing your balance sheet along with your P&L, you could soon find yourself in a cash flow squeeze. Your balance sheet records and manages assets, liabilities, and net worth. Awareness of how your assets are deployed and the understanding of certain ratios is key to building wealth and having financial peace of mind. Let's talk about these balance sheet ratios, of which you should become very familiar. The first is working capital. It's the difference between current assets, that's cash, investments, inventory, accounts receivable, and current liabilities like payables, accrued time off, taxes due, and this year's interest and principal payments. While working capital is typically depicted as a dollar amount, we can translate that into what's called the quick ratio to help determine your business's health. The quick ratio is current assets divided by current liabilities. It's an indicator of a practice's short-term liquidity and measures your ability to meet your short-term obligations. A good quick ratio is 1-to-1 or higher. In other words, your current assets equal current liabilities. But you don't want it too high. If yours is 2.0-to-1 or higher, in other words, twice as much in current assets as current liabilities, you may not be deploying your assets effectively. Another very important balance sheet ratio is days receivable outstanding. Let's say you generate $800,000 in annual revenue. You divide that number by the number of business days in the year. Let's use 250. In this case, the result is $3,200, the average amount of your daily collections. Now take your accounts receivable balance, let's say it's $100,000, and divide that by your daily collections amount. The result of this calculation, 100,000 divided by 3,200, is 31.25. That's the number of workdays that you'd need to collect your accounts receivable based on your average daily collections. In our industry, a good days receivable outstanding is 25 or lower. Thus, in this case, the practice has an excess of 6 days receivable outstanding. Your DRO is too high by about 20 grand. Collect that cash and put it to work. Another important key performance indicator that's tied to your balance sheet is inventory turnover. Let's say you sell 2,000 frames a year. If you want the desirable inventory turnover of 4 times or higher, you should have only 500 frames in inventory. This can be measured in dollars as well. If your inventory is $100,000 and you sell 300,000 frames annually, your turnover rate is only 3 times. That means that in this case, $25,000 worth of inventory assets are not being effectively deployed. Remember that there's a carrying cost to inventory. That $100,000 in inventory doesn't appreciate as money would in a bank. You can reasonably figure that the value of inventory depreciates by about 5% per year because were it cash, you could earn that amount by investing elsewhere. In our work, we often discover that a client simply doesn't manage their balance sheet at all, both business and personal. It pains us to come across clients who struggle to build wealth. Indeed, most doctors are the working rich. They have income but not liquidity. This is because doctors start their career later and often have large student debt. But it's also because many doctors live above their means. It pains me that we often encounter optometrists who must work well into their 60s because they haven't been prudent with investing their income. Managing cash flow is mission critical to building wealth. If you're not currently saving at least 15% of your income, we should talk. Odds are that you have unproductive assets that can be better deployed. Give us a shout for a no-obligation chat.
We hope you enjoyed Al's message, and if so, please hit that like button. At Cleinman Performance Partners, our team is dedicated to transforming lives through recognized and realized possibilities. We have resources in nearly every aspect of the business of optometry and the experience to help you get where you want to go faster and easier. If you'd like to explore your possibilities or challenges, contact us today at Cleinman.com. We're here to help. For more great videos that educate while they entertain, please subscribe to the Cleinman Performance Partners YouTube channel. Thanks for watching.